So with that, we go from a digital health unicorn to a Columbia alum and an investor who is one of the most prolific in New York City, in New York, and really in the U.S., and someone who has helped create unicorns in healthcare and digital health. Saul, welcome to the program, and thanks for joining us today.
Thank you, Stan. Great conference. Happy to be a part of it.
Yeah, I appreciate it. And again, for the HITLAB audience who are not familiar with Saul, and you certainly should get familiar quickly, he is the founder and the managing partner of Rittenhouse Ventures, again, based here in New York City, and has a very prestigious and prolific career in healthcare and specifically in digital health. Folks that do a lot in healthcare, sometimes they'll stay with the molecules, they'll stay with the devices, they'll stay with some of the health infrastructure stuff, but they won't really get into the digital. And Saul is a veteran of many decades in this area, understands it front and back, and he's going to talk to us today about what he's actually doing and some of his experiences, and then we'll take some questions too. So again, feel free to hit the chat box or my LinkedIn page, and we'll get your questions answered, as many as possible. But Saul, I'm going to hand the virtual podium over to you.
Great, thank you. I didn't know if we're having slides or not.
Well, if you have something you want to present, great. If not, we can just do an interview. It's really whatever's easier for you.
Yeah, I'll throw up a couple slides just to create some discussion here. Give me 1 second.
In the meantime, while you're doing that, if you want to give the folks a little bit of your background, how much Columbia impacted all your success, we love to hear about stories like that.
Sure. I'm the founder and managing partner of Rittenhouse Ventures. Just to correct, we're based in Philadelphia. We kind of invest in the Mid-Atlantic region, all the way from kind of DC to Connecticut. I have 2 degrees from Columbia, a Columbia College degree and a Columbia MBA, and have been an investor in healthcare IT for over 20 years. Columbia has been a real, my brother is a physician who's affiliated with Columbia, and really, and I helped him start up his practice 15 years ago from scratch. And so I'm very familiar with a lot of different aspects of healthcare and have been investing for 20 years. So Stan, what you've created here is really helpful, and wanted to talk about, just to add some perspective, a lot of healthcare. If you look at all the venture capital that's ever been invested in healthcare, most of it has been invested in the last 5 years. And so, when you look at the startup world, I think it's important to understand the context of where we sit within startup world in respect of all the various cycles that we've gone through in the past and that we're starting to go through now. So just to talk about for a minute, and I don't want to be too pessimistic here, but I just went back and ran the numbers on Teladoc, which is a marquee company in the telehealth that's doing about a $2.4 billion run rate revenue currently. And in 2021, in January 2021, the stock price peaked at $287 a share. They bought Livongo. The market cap was about $36 billion and was trading at 23 times revenue. The current price, and this is from a week ago, is about $28 a share. So 90% decline, $4.5 billion market cap, and is trading about 1.8 times revenue. So run rate, that's a 92% decline. If you look at the growth of the company actually grew last quarter 3% quarter over quarter. If you compound that, that's a 15% growth rate in a market where people think telehealth is contracting. There's obviously some fundamental problems, but there's been a massive public market compression of valuation of multiples, and that's really flowing through to the private markets. I think, a couple things I'll point out here is, if you look at 2012, which is the first year on here, the average deal size in venture capital was 11 million, and there were 146 deals. If you look at the peak year, which is last year, the average deal size ballooned to 40 million, and there were 736 deals done in 2021 in healthcare digital health. what we saw is a tremendous growth in the average round size. We saw a tremendous growth in the number of deals, and this has been a really exciting space to be in. But I think that the excitement level, which is justified, the funding excitement was really probably greater than the reality of the market opportunity and the growth from that perspective. So we're seeing a normalization. If you look at, this is through 3 quarters of 2022, the funding rounds will probably be down 40%, and the funding size will be down, from 40 to 27 million on an average deal. And there's really going to be a significant compression in the amount of VC funding. And so I wanted just to spend a moment and offer some perspective to the startup opportunities. Having been in venture investing in healthcare for 20 years, there's really only a brief period, if you look at this, where healthcare and digital health, the technology side of healthcare, has been viewed like a SaaS business. And so I don't think we'll get back to those multiples anytime soon. And therefore, I wanted to spend a couple minutes just talking about the lessons for a startup, and then talk about how it kind of plays into alternative strategies. So how does a digital health startup cope? Sequoia put out a deck in May when the market was coming down, and they're very famous for calling these markets. And they said their title was "Capital was free and now it's expensive." So chasing big markets is very exciting, but embracing reality that capital costs are going to go up dramatically means that each company needs to adapt quickly, and that the pain of discipline, and that means methodical spending, is much less than the pain of regret. And so watching your cash, spending it more methodically, and that allows you to emerge stronger out the back end when, your competitors and other market spaces have spent aggressively without the ability to raise the follow-on capital, and you've been more methodical. And so really the lesson here from startup world is focus on surviving and then thriving. The great thing about digital health, and I was watching the Merck presentation from yesterday, it was talking about value-based care and how 50% of people want to be moving towards value-based care, but the actual percentage of value-based care is much, much lower because the tools aren't there, and the evolution of the healthcare system takes a long time. The startup mantra of the first person wins it all, and you need to be fast and spend a lot of money to be the first mover, is not so true in healthcare. Digital health evolution is a really long game, and the rails, the payment mechanisms, and the thought process of the various pieces of the system, the payers, the providers, the physicians, the hospitals, everybody along the way evolve, but they evolve relatively slowly. And so you don't need to run to be that company that's front of the market and spend $30 million to be that fast mover, because the change is going to probably happen a little slower than everyone expects, and sometimes a lot slower. So focus on profitability and efficient use of capital. Only raise capital when needed. Be very strategic regarding your runway and fundraising timing. You can't fundraise unless you've hit another value inflecting milestone. And that's really a challenge. And then the upside, and there are other upsides too, which is that this is a great environment in terms of the infrastructure is really in place, and there's a rapid pace of change relative to the digital health evolution over the last decade. Is that, there was a time in the last 24 months when you would look at a niche and you would say, hey, this is a really exciting niche, but there are 20 very well-funded startups and you're one of them, and you have to outspend the other 19. And as the funding contracts, you're going to see fewer new companies to compete with, and the winners will sort out in a little more methodical space. So So those were just some thoughts. You know, we're a small venture fund, writes checks of $1 to $3 million into rounds under $5 million. We really focus on capital efficiency, and we've been fortunate enough to take a company public that only raised $8.5 million from start to IPO, and the founders owned 50% and had a multi-billion-dollar market cap as a public company. And so it's you can build technology companies, especially even in digital health, methodically with relatively little capital, and it's a very founder-aligned strategy. And so just wanted to talk about how this got lost at the last 3 years during this very frothy and exciting market, but there's a lot of opportunity here to build more methodical companies, and there's a lot of smaller areas where you can build really great companies, and those are ones that we focus on. So with that, I can open it up for questions here. Stan, so I don't know what we could cover. If we have any questions out there, that'd be great.
Absolutely. So this is a great presentation of data, and Saul, this is the kind of expertise that someone who's been doing this as long as you have and has been through as many ups and downs in the marketplace as you have really gets. And it's pretty clear, these bullet points, and in just about 10 minutes, you're able to add more insight than just about anyone else out there. So really appreciate that. A lot of questions coming through, and certainly, I think one of the ones I'm seeing on LinkedIn from John is, when you're looking at this market, and you talked about how it's a 5 to 7 year build, maybe even longer. Even Livongo was founded in 2013, and if it weren't for a pandemic, that exit would have never happened. And you look at that, was roughly a 9-year runway to get to the highest multiple in the history of Silicon Valley on any revenues for a sale of a company. But that was highly unusual. What have you seen as the accelerants, if you will, to the growth of a company, whether it's the management team, the technology? Let's take out pandemic, since that's hopefully going to be an outlier. And what are the accelerants that you've seen that have allowed digital health companies, health IT companies, to accelerate their glide path from idea to IPO, from instead of 13 years or 10 years, more like 3 to 5 years? Have you seen that kind of componentry, that kind of variable where it was that X factor that really exponentially grew that value creation and ended up finding a very nice growth pattern?
Yeah, I think you have to think about healthcare, digital health as a 5 to 7 year growth process. The change, the pace of change, the pace of adoption is very, very hard. I remember, when I made my first healthcare investment, it was a nursing staffing optimization company, and we did our first pilot, and the ROI came back at 16x. Okay, so for every dollar you would spend, you would save $16. And in the non healthcare world, people would be falling all over themselves to buy in like a week, right? Because 3 weeks later you would pay back all of the costs of the system. And I remember we still had a 9-month sales cycle for this product. And so I just think that because of the interaction of the various players, it takes longer to prove out ROI. It takes longer to prove out a repeatable sales process. And I think that and there's a lot of noise and distraction of priorities in the various pieces of the healthcare system, fighting for. So even if there's a very high ROI opportunity, the change factor and the bandwidth factor can really make that take a while. I do think that there are a tremendous number of fast followers, and so if you can get those 20 to 40 leading groups to go adopt some technology and prove out the ROI, the followers come quickly. And so there is a crossing of the chasm that can happen pretty quickly. But I think it does take 3 to 5 years to get those proof points, and then those last 3 to 4 years you can kind of ride the adoption wave and grow from that perspective. And I think that very importantly, and you asked a question about people, it's very important to have fundamental knowledge of the healthcare system. There's a lot of software people who wake up and have a technology idea in the healthcare space. It's really important to weave in folks who understand the evolution of the healthcare system from that perspective. It's a lot easier today than it was a decade ago to find those people, but it's really important to understand that it's a very relationship driven business, and there are only like 1,500 fast adopting hospital systems in the United States. And if you want to get in the hospital systems, you got to know someone who has a Rolodex in that area. And it can't just be a salesperson who's trying to sell, SaaS software. This needs to be people who understand healthcare and who live and breathe healthcare for a long period of time. So.
Right. So effectively someone who can be an expert, or someone who's been going to CIO meetings or going to CMO meetings, and has either board contacts, things like that, to really accelerate the adoption of these sorts of things, at least the socialization of these models. And in your experiences, Saul, what have been one or two of the most widely, or the fastest, if you will, that have really been able to accelerate that glide path because they had those connectivity points into the boardrooms or the C-suites, and they could actually reduce the time of that sales cycle from 18 months down to 3 to 6 months?
Yeah, I mean, I think, depending on where you're selling into, you could be selling into the tech side of pharma, you could be selling into payers, you could be selling into hospitals, you could be selling into all different areas. They're very, very different Rolodexes, and they're very different thought processes and selling owners, and having someone who knows that and who can weave that. It's very hard to cross-pollinate between these different markets. And so if we have a number of companies who sell into both the pharma world and the payer world and the provider world, and you have to have different people with different skill sets and knowledge bases to be able to manage that. And it's a hard thing from that perspective. So
it really is. That's absolutely brutal. There's no doubt about it. And so one of the X factors is clearly this idea of having someone who is connected into the boardrooms and the C-suites. And again, seeing more questions come across on LinkedIn here. But one person's asking, have you ever seen a technology that became almost like the FOMO took over, and boardrooms and C-suites are going after the company because they needed to get it deployed, either to save money or improve outcomes or make money?
Yeah, I mean, you see that from time to time. We're generally not investing in the kind of unicorn fast rising companies because of our strategy. We're writing smaller checks and being more methodical, but the infrastructure that you need for analytics and for a lot of the value-based care pieces, there are connectivity points that are really essential for getting data in and out of EHRs and being able to use all these AI tools that are emerging. There are a lot of areas where there are opportunities there. I invested in a connectivity company thinking that the connectivity will emerge and unite on a single standard, and this was a decade ago at this point, and we've gone through a bunch of standards, and they always work better on paper than they work in reality. But I do think we're getting to a point where the data's starting to flow more accurately and more effectively across platforms. And I think those technologies that can have that data flow and allow it to be used very rapidly and intelligently, and merge together all the different forms of data, prescription data and interaction data and daily physician and hospitalization, and make all that data, those companies and some of the standards that are emerging today, I think do offer the opportunity to have some really fast adopting technologies. I just don't think they'll ever adopt at the speed at which other areas of SaaS software and standards do, just because there's too many interlocking pieces. there's too much government funding, and all of these areas. And I don't say, when I say too much government funding, I don't mean that as a judgment. I just mean there's too many regulatory changes and infrastructure changes that will never change at the same speed as Google Analytics changing their tagging form, and the whole industry has to change in a week because they're sunsetting the old system. That doesn't happen in healthcare. There's too many interwoven pieces of the infrastructure, and they take years to change. And there's usually years of ruminating on that change before the actual change takes place. So, Stan, I don't know when's the first time you heard value-based care. I don't know what year, and
20 years
telehealth,
ago, yeah.
Telehealth was happening in the early 2010s, and then finally really came to its fruition only in the last 4 years, right? So there's been a lot of concepts that have gone through the this is going to happen any minute, and then a decade later they happen, and that's really what happens in healthcare, which is why spending a tremendous amount of money to be the first winner is not always the right play in our mind. And sometimes you can find a great niche and build a great business with relatively little capital, and that's really where we focus. But that doesn't mean there aren't, rapidly changing technology pieces, and there aren't big wins. I just think they never will adopt at the speed at which some other areas, just because of the complexity and the size of the system. I mean, healthcare is such a big percentage of GDP. It's that it's not. It doesn't change in the same time frame as other areas.
Agreed. And it's really, I think that's something that we're really trying to hack, if you will, and really finding out what are some of those parameters. You've named some of them already in terms of, that X factor of having the person who's hyper connected. And that's why you look at Glenn Tolman and what he was able to do with Livongo. He is one of the most connected people in digital healthcare. He's been around for 4 decades. He understands. He's had 3 unicorns. He gets it. That's why Transcarent, you're seeing the adoption rate there pick up nicely on the infrastructure side. We do have a question, and again, I apologize if we're going a little bit over, but a lot of questions coming in, Saul. Obviously, we're not surprised. We kind of thought this might happen, so we have some open time here, but is that okay with you? Are you okay on time?
Yeah, sure, I'm good.
I appreciate that. And so the idea from, and again, this is from Rich, and he's a local in the Philadelphia metro area, so he might even be a nice person to talk to, but he's actually asking if you have any ideas on the kinds of risks and opportunities for some of this virtual first stuff that's been coming around. It got real popular, obviously, in kind of spring and summer of 2020, and then through the 21 seasons. Everyone got into it. Google, all the big tech companies, Amazon, and so the idea now is, what are you seeing with virtual first? Is that something you're getting into? Are you seeing that as the tree bent, but then it just stood right back to the midpoint again and came back up, and we're down back to near single digits for virtual healthcare? What are you seeing, and what are you anticipating?
Yeah, so that's a big question, and I'll take pieces of it. In my mind, the most important thing in healthcare is getting the right treatment at the right time. And in a pandemic, that might have been very different than it is today in a normalized or normalizing environment from that perspective. So for certain interactions, there is no value greater than a face-to-face physician visit with a to read the physical body, to read the emotions on a deeper basis. But we've looked at a lot of chronic care areas, and so the standard of care in COPD, for instance, is someone is having a situation where they're having some early signs of oncoming issues, and they call up their physician and they say, hey, can I come in? And they say, oh, come in 3 days. And it takes about 36 hours to have a full-blown incident that requires an ER visit. And so the right care, even if it's just a 10-minute video triage and say, okay, hey, take this, we'll give you you're in real distress, and so we're going to give you an appointment tomorrow, and in the meantime, take this medication, which you already have on hand. Those kind of preemptive chronic care management is going to be a mixture of virtual and human. So we're an investor in a chronic care, virtual chronic care company, a company called Cecilia Health. They started off in the diabetes space, but they're across many chronic care areas. They're moving towards a full virtual endocrinology practice on a national basis for areas where there might not be proper diabetes care in the nearby area. So there's there's a lot of geographic areas, and I do think that virtual first will work not only in primary care, where clearly a number of large players have been investing, but also in the not necessarily in the initial diagnosis of chronic illness, but for the ongoing maintenance of chronic illness is tremendously useful. It's also very useful for medication onboarding, which is one of the areas that Cecilia Health focuses on. There are a lot of really high value areas for virtual care. I do think that everything's going to go virtual thought that we had is not playing out, and no one thought it would. But the long-term role of virtual care as a side care assistant to in-person care, I think the hybrid of that is, and the risk benefit of waiting for that in-person care versus that immediate telehealth version is really the trade-off that we're still trying to figure out. But there's clearly a role for virtual first, and there's clearly a big role for in-person as well. And the model that solves that, we'll figure out over the next decade, but it's going to take a while, and it'll also change as the average age of the patients and the technology adoption of the patients and the physicians also, and the other care members and part of the team, not just the physicians, but the other care members. So it'll be interesting to see how that evolves, but clearly there's going to be a big role for both areas.
Yeah, it'll be interesting to say. I think one of the things that we have seen, right, is this adoption of these virtual first HMOs and some of the virtual first ancillary services that hospitals are now utilizing. Whether that actually takes an uptick. I probably talk to 1 or 2 people a day that just do telemedicine now. They don't go to the doctor anymore unless they actually have to go to the doctor. And obviously that's a massively confounding variable, because I know mostly folks that are love digital. And so it's obviously not the norm, because we're seeing just the statistics come in from the national level, and folks are back down to high single digits, low double digits adoption and usage really of these telemedicine services. So it is interesting as we're seeing the underlying systems of health payment and HMOs using this. It's not necessarily the consumer that's feeling empowered to do that. And and it's a complicated process. Let's be clear. Telemedicine visit, for some telemedicine visits could be 10 minutes of tech support and then 5 minutes of actually talking to your doctor. So it can be frustrating for both the patient and the physician. And so it really is something that's not quite as easily as something you do on, if you go to FaceTime with Apple and talk to your kids or, your friends or whatever with a quick video chat on an iPhone. So it's not there yet in terms of that simplicity.
Yeah, I would say, one area where that's clearly playing out very aggressively is in the mental health area. So I do think, real-time crisis intervention, so it's another chronic care area from that perspective, but mental health, shortage of practitioners, tremendous amount of need driven by some of the disconnected feelings of people during COVID, and so I do think that might be a big area, but it also needs to be very humanized, because if you're isolated and someone's trying to coach you and it makes you feel more isolated, that's not going to be really helpful. So I think that finding that balance will be very tricky, but I do think there's a very interesting growing role there for that. So,
and just for the audience, we're getting some questions on LinkedIn as well about the investment area that you focus on, Saul, for your fund right now. I think you're on like fund 3 or 4, if I remember correctly, when we were talking last. But
Yep, fund 3.
what's the size of your fund? What number are you on? And what's your focus? What's your thesis for this one?
Yeah, so we're a $20 million fund, focusing on digital health. It's about half of what we do. So we're a regional fund, focusing on the Mid-Atlantic region. And we're really looking for capital efficient digital health companies and technology enabled services that can grow relatively on relatively little capital, and with experienced entrepreneurs who can roll up their sleeves and bring some deep expertise in areas of healthcare that they're working on. We don't have a tremendous thesis-driven area in the sense of, we're not saying, oh, we're going to be virtual first or telehealth or whatever you want to call it. We have a deep expertise in hospital operations technology, of which there's a lot of change, and pharma IT, the IT side of clinical trials and drug onboarding and medication management, where we have a lot of experience. But we're looking at some of the less competitive areas where we're not trying to boil the ocean, and you're not going to need to, raise $100 million to win. And so a lot of these, so I don't know if that gives you some good understanding of the areas we find exciting, but we're very excited about the number of opportunities, and we're very excited about investing in a bumpy environment, because more methodically spending companies, which are generally created in these environments, have a greater chance of success and often lower competition rates. And we're not going to be the 17th company funded into a small niche where we're going to beat each other's marketing brains and sales brains and chasing a market that's small. We'd rather be investing in an area where we could be the leader with relatively little capital. So those are kind of our thoughts.
That's fantastic. Yeah, that's a smart play too. That's obviously what folks have to do these days in terms of this value investing motif, and certainly value investing having been created and developed out of 2 professors in the 1930s at Columbia Business School. Although I know you graduated much later than that, so you never got to know them well. But the idea is that what Graham and Dunn did back in the 30s and writing the first textbook, and really the initial textbook on value investing, creating that methodology, is what we're seeing today for people like Warren Buffett and other massive investors that have really been able to find very strong assets that don't need a ton of capital to turn around and do well. And obviously you're doing well there too, so that's good to see. So again, Saul, tremendously impressed with your career, your background, and really appreciate your generosity with your time and really helping educate our audience here for the 9th annual Digital Health Summit. And we're looking forward to collaborating with you and talking to you again soon. Have a great rest of the year. Have a great holiday, and we'll catch up with you in the new year.
Thanks, Dan. And again, congrats on such a great conference, and the hybrid model, I think, is a great one. So thank you for all your work.
Yeah, likewise. Take care. And so we've got, so many lessons learned from what Saul has done and what he's doing with his firm. And, there's a lot of conversations to be held here about the comments he's making about digital health, health IT, bioinformatics. It really is something that has a runway that is traditionally 7 to 10 years. And a lot of what you're seeing from his perspective is that there are ways to hack that runway. There are ways to break that mold of almost a decade of growth before you go from idea to IPO or exit. And that really does, oftentimes signal real value creation within the ecosystem. Although if you talk to Glenn Tolman, he will say that an IPO is ultimately one of the best validations in a free market economy, because an IPO, through the rigorous scrutiny it takes to actually file for an IPO, through the amount of critical acclaim you receive or not acclaim you receive, is important for investors, for buyers, as they're reading through the company that's just gone public. it really does provide a bit of a stress test, and then the press that comes out of that, even though if the stock's down, still having that press and that kind of consequence of being able to go into a boardroom or C-suite and say, here's what we're doing, here's how we're doing it, and here's the growth that we're seeing, and oh, by the way, it's all transparent. Take a look at what you're looking at in the press, online, in SEC filings, et cetera. So again, Glenn Tolman's done a number of IPOs in his career, and recently did a SPAC with Transparent. So he has a really good understanding of the capital markets, and it's not a bad thing to look at some of his experiences and use some of those as track records to adopt and to use as well.